Hello, traders. It's 8:01 a.m. Chicago time on Monday, the 30th of September, 2019. Please give me a sound check. Let me know if I'm blowing out your headsets or earphones. I'm not sure. I'm on a different workstation today. Uh, Today's episode is number 1606, not 1906. We'll get that fixed. Um, Derivatives trading involves substantial risk of loss. It is not suitable for all investors. Past performance is not necessarily indicative of future results. This morning, the overall sentiment is fairly mixed. We do have the Euro stocks leading the pack, but not by much, 11 points. And the dollar's up 27 cents. The dollar is at 99.03 on the December futures. The DAX is up 21.5. The laggard today is oil. Oil is off 1.36%, down 72 cents, trading at 55.21 on a November contract. And also gold is continuing its drop. It fell through 1500 and is trading at 1,490. I would say the allocation is meh, ever so slightly to risk, ever so slightly. I would say the overall allocation overnight is mixed as it stands right now. So that's where we are this morning, given the activity that has taken place. Um, that has taken place in on Friday, the selling. The theme of this trading day is squarely sitting on the shoulders of this issue with the concerns that the U.S. may delist Chinese companies on U.S. stock exchanges. The market really took that hard and dropped quite a bit on Friday and then bounced back up. Pretty decent bounce. We didn't quite get to the 50%, which is the low volume node of the ES. We'll look at that in a minute. I'm getting ahead of myself. European shares steadied amid uncertainty over trade negotiation, while stocks in mainland China and Japan dropped. The dollar rose against major currencies as investors sought the safety of the greenback, hurting demand for gold. Oil prices were down on weak economic outlook. That's where we are today. That's what we're looking at. In terms of the calendar, this morning we did get GDP out of Great Britain. We got inflation out of Germany. What's left, what's ahead of us is we get Chicago PMI. This will be a number that's released to subscribers first, should come out at about 9:41, 9:42 a.m. and then to the public at 9:45. It can move the markets. It hasn't had any real impact lately. The expectation is 50.2, 50.2. And then from there, we're pretty clear until about 7:50 p.m. Eastern U.S. time for the Japan Tank and Large Manufacturers Index. So the deck is clear. We do get the RBA interest rate decision out of Australia. The expectation is a drop of 25 basis points. The week does have, since it's Monday, the week does have some quite a few releases. We have market manufacturing PMI out of Germany tomorrow, ISM manufacturing PMI for the US. And then on Wednesday, Japan consumer confidence, balance of trade out of Australia. Thursday, ISM non-manufacturing. And on Friday is the big day. It's the first Friday of the month, so we get non-farm payrolls and unemployment on Friday, and the market's going to be paying attention to that. I want to remind you, it is the last day of September. It is the last day of September. It is month end and quarter end right now. And so I expect that there's likely to be a fair amount of movement into the close as we window dress for the quarter. Let's take a look at what was expected on Friday versus what we got. This is what the expectation was. The primary scenario, since we put in a higher low on Thursday after a run up on Wednesday, we put in a higher low and we ended up with an inside day, and we're gapping the higher probability play. Remember, I talked quite a bit on Friday about the 29.91.75 action, and how important that is. The low volume, the MC low volume node of this region, very important area. But because we were gapping up slightly on the open potentially, the expectation is for, in either case, a drop into the prior range. On the primary scenario, we would expect the drop to be immediately jumped on by the bulls at 29.8475, 29.85, and a push to 3,000. That's what was expected as a primary scenario. The secondary is actually what ended up working out. We get a drop into the range, consolidation of 2981, which is the high volume node in this area, and then a continuation drop down into 2970. Uh, the news, of course, throws a wrench in everything, as it always does. Here's what actually happened. So that's what was expected. Those of you who were here on Friday, could hear what the plan was, and what we got is the push, an orderly push down to 29.73, where we popped. Remember, here's the plan. The plan was to push down into this area, consolidate, and pop higher, right? So 29.73 down to 29.70. I expect turbulence in this area, as you can see drawn here in pink, and then a pop higher, which is exactly what we got. I mean, it doesn't always work this well. I just don't want to pretend like I was able to predict the future. We got the pop higher right here, and then we ended up with the news coming in right in here, right in the 29.30 85 area, which dropped this. The market attempted to recover, and then it just could not recover. With it coming into the weekend on that news, it is hard for the market to make it all the way back. My expectation was the 29.64-65 area would hold on a retest, and it did into the close here. However, the S&P minis did finish inside of the one volatility sigma, the 20-day historical volatility. We calculate the bands for that, and we figure out how much volatility for the day, or how much range for the day, close to close, exceeded the normal, the expected volatility of the session. And it turns out this pop higher really brings us back into what we would consider to be a normal close, despite the wide range. Okay, so we covered on Friday, we covered 42 points, something like that, 42 and a quarter points. Pretty good range. And you could see that the volume down here is much higher than the 20-day mean volume, which is represented in black. The little black bars that you see there, that's what the volume is expected to be on the 15 for each 15-minute bracket. You can see it says 15 up here, 15 minutes. And you can see that the market far exceeded that. It was in line until the news. And then after that, it became very active. You could see that the actual volume on those 15-minute brackets were much, much higher than the 20-day average for those brackets. So very odd behavior on Friday. Let's zoom out a little bit as part of our review and bring in this blue profile, which I don't like having it as blue. Let's make it a little more stark and turn it red. So this is the range that we've been in since the beginning of September. The beginning of September, we gapped up. On the 5th of September, we gapped up and we started to trade in a range. We pushed to 2350, 2350. We pushed to 2450, and then we rotated all the way down. This looks like we call it a failed auction in the auction markets. in auction theory, which is what I how I look at the auction. I look at the market as an auction, as a continuous auction, and you could see that it pushed the high by 4 ticks before failing back in. And as we monitor where the key acceptance and rejection areas, so there's a rejection area, there's key acceptance here, here. There's the ultimate price that is accepted in terms of volume, which is the 3,000 figure. That is our MC point of control. That's our point of control. It is the highest price, it is highest volume price in this area. And then we shifted the most accepted price down in this region to 29.77 and a quarter. And so as long as we stay, again, same theme as Friday, as long as we stay below this 91.50 area, we are likely to continue to get tangled in this high volume node, and it is really catching up. You can see that the volume here is starting to catch up with the point of control, and the point of control may shift down, signaling that the market is actually enjoying or agreeing on lower prices than 3,000. The market's having a hard time facilitating higher. Not only that, but on the weekly, we had what is called a an end to the one-time framing up. So if we look at a weekly chart, well, I won't go into the weekly, but if I color in last week, this is last week's range from the 23rd to the 27th. From the 23rd to the 27th, and you can see that the prior week, which is right here, this is the prior week, you can see that we put in lower highs, lower lows, and before that, we had higher lows. There's a higher low, there's a higher low. This means that we are one-time framing up. In other words, the major trend, the weekly trend, is facilitating trading to the upside more easily than to the downside, and we ended up breaching this low at 29.8075 last Tuesday, and that ended the one-time framing up, and we may be setting up for one-time framing down. We are overall imbalanced. This is last week, and you can see that the box for last week occurred below the box of the prior week. What does this all mean? Well, what am I talking about? What I'm talking about is the market might find this price down here much more easily now. Much more easily now as the week was spent clearly facilitating prices lower more easily. In other words, the terrain has shifted to the point, may have shifted to the point that it may be finding lower prices easier to attain than higher prices. Does that make sense? I hope it does. And so my view on the week is somewhat bearish. Now, that could all change. It could all change with a tweet or whatever, some other non-impeachment, double impeachment, who knows? That could change very quickly since this is a purely news-driven environment that we have, where the market is party to a reality TV show that's playing out in real life. And so there are many surprises. And overall, though, the market is really having a hard time pushing and maintaining higher prices. I mean, last Tuesday, it got above 3,000. It fell right through. It finished, it poked it on Monday, finished below. The next day, it got above and it immediately got below, pushed below. And the next few days, Wednesday, Thursday, Friday, it had a really hard time getting above this low volume node at 91.75 that I was just talking about. This is really setting up for sellers to be stronger and stronger and buyers to be weaker and weaker on every test. Therefore, and I'm not going to say mark my words because the market has a way of showing us, of humbling us all, but there's a high probability of seeing 29.27 over the next week, days, I don't know what time frame, but I'm expecting the market to push down to this most accepted price below. Okay, so be careful if you're swing bullish. Not saying lose your plan or close your position. I'm just saying that the market is saying something here about the fact that it's just not able to take on higher prices. Okay, so that's that. What do we have for the overnight session? What do we have for the overnight session? What have we done overnight? Oh, wrong chart. Where is my overnight chart? Okay, I must have mistakenly closed it. Let me open it up and show you what has happened overnight and how that's coloring the action for today. Voila, it is opening. All right, so the overnight session, a gap up that quickly moves back almost to the prior close, and it's completely balanced here. We have what looks like an excess high overnight at 29.80. So my expectation is the market again agreeing with the weekly, agreeing with the action on Friday. Again, the market is unable to maintain or hold prices higher, and it's facilitating lower trade more easily. It stayed in a box. We have a nice little zipper here for the European session, and it's releasing itself to the downside. To me, it is likely to trickle its way down. That's what's likely to happen. Now, again, it is month and quarter end today, so who knows how we end up today. But over the next couple of days, I would be very weary of a swing long. I would definitely be cautious there. These are early signals, early days. But to me, we have a weak low, and this is likely to take out the low as we open. And of course, we haven't tagged the prior close. We haven't tagged the prior point of control, and those are magnets. So, and then let's take a look at CT Bookmap. For those of you who didn't attend the Wednesday webinar, I shared a lot in last Wednesday's webinar when I talked about order flow. I'm going to post that the link to that here on my feed this morning at some point. It's been a very, very incredibly busy week last week, and I wasn't able to post it. But if you look at the overnight session and what it has accomplished, you can see that it's just noise, noise, noise. There's just not much there. The overnight high 29.80 and a quarter it doesn't even get picked up on my chart here. It actually occurred right here, but you could see the offer just sitting here for the entire session. But down below there's the long offer. What happens to it? As soon as the market starts to drop, it cancels. And the next big offer down there is 29.60. To me, the order flow is also showing a potential better facilitation of trade to the short side. Again, I don't want to lock you into a bias. Just be aware that that's how things are shaping up. So that's what the order flow looks like for today. Let's take a look at what's expected for today's session as we go through our key trades of the day. The key plan trades for the day. Let me get my colors right. Scenario 1, we are right on top of the low volume node from Friday. Very important here. Very clear separation of the distributions. I expect that overall we open in an open auction in range that attempts higher, but I expect that the impulse, the first key impulse, will be to the downside. And I expect us to tag and mess around with this open point of control at 61.50. And then I'm looking for it to squeeze lower, probably in a kind of a more grindy sideways action. But I expect that overall the facilitation is likely to be to the downside on scenario 1. I don't have very high expectations. Keep your ears peeled for your news feed. Again, if you are a part of Convergent, you should be running your Trade the News feed. It's $185 that's included in your um, in your subscription, which costs a third of that. So just make sure you run it so that you're aware of what's coming and what rumors there are and whatnot. The secondary scenario is an open auction that takes out the low immediately, grinds its way down, may impulse up, push through the low volume node to 74 for the overnight point of control stat, and then sits sideways before drifting down into the close. This is my secondary scenario. Now there's a pretty good probability of a scenario 3 and 4, open test down, drive up, open test up, drive down. I won't draw those. But you've noticed in both scenarios, I'm looking for it to facilitate trading to the downside. It's the easier path at the moment. Again, be careful here because my goal is not to paint you into a corner and make you think short only. This is just what I'm sharing with you here is simply what is the more uh, what is the easier way for the market to move? What path is easier for the market to move? And and that's what I'm looking at. I'm looking at the facts in front of me and the expected play on those facts. Again, what are you doing today to win the day? What are you doing today to improve yourself as a trader? I don't care if you're making 100 grand a day or you're scraping by and breaking even or losing a little bit. What are you doing today to win the day? There's a big long thread on twitter.com/futures trader 71 that I put up yesterday as a result of my observation and many, many emails as to why people are struggling. I would say it's the holy grail of Twitter threads for traders who are having a hard time. I suggest you check it out. We'll post it on the Convergent forum for others to have. I invite you to go check it out. I'll link it in here. Good luck today, and I'll catch you tomorrow. Take care.